Welcome back, everybody, to the Informed Homebuyer Podcast. I'm your host, Rich Curtis, and I have with me, as always, my co-host, Dave Miller. Good morning, Dave. How you doing?
I'm good, Rich. Thanks for having me.
All right. Well, we are back to you to talk about the roller coaster that is the U.S. economy and how that is affecting the housing market. We've got a little bit of national numbers for you, a little bit of state numbers for you, a lot of local numbers for you. Dave's going to go over what happened with the recent Fed announcement, how we're seeing that play through the market, and where we think it's going. Are the signs pointing towards recession, like all the headlines are blaring at you every day? Or are they not pointing towards recession and there's a cheerier outlook? We'll find out by the end of this one. Let's start with you, Dave. What did Jerome Powell tell us in his recent Fed announcement last week?
Well, I think a couple things he told us, Rich, was that the economy appeared to be stable. He also, mentioned that he's got a dual mandate charter to manage unemployment or employment as well as manage inflation, and those are two, kind of opposite end of what their tools are in terms of lowering and higher interest rates. One's going to affect one versus the other. And so, typically to lower the Fed fund rate is going to, obviously stimulate the economy in some regards and ideally add employment. Companies are going to ideally start hiring again. And there's more optimism. But the problem is inflation is still in the high twos. It's not at the desired 2% number. So a little bit of concern there in terms of what does he do. So, last week the jobless numbers came out. They estimated 222,000 jobless claims, and we came in at 222,000 jobless claims. So kind of right where they expected.
Well, that was up from their last update. So we are seeing jobless claims rising.
Yep. So the prior actual was 216,000. So that's kind of going the wrong direction in terms of jobless claims, not ideal, but also simultaneously to that is like I mentioned, is he's trying to manage inflation. We're not at those comfortable levels, that consistent 2% that the Fed's looking for. And he's also mentioned that, and again, this seems to be the theme of not just our informed home buyer here, but tariffs. He's mentioning that again, these tariffs are on again, off again, and he can't just use the most recent data. He's got to take some lagging numbers to know, is this a trend or is this a one-off, right? Like, we can't just lower interest rates because 1 month of numbers or 2 weeks of numbers point in one direction. You got to wait and see, is that a one-off or is it a trend? But the tariffs are on again, off again. They don't know if they're coming or going. So he's got to, kind of hold his ground. He's been pressured by the administration to lower interest rates. But that's not what his charter is. His charter is to be apolitical and maintain a economic and inflationary environment is what they're there for.
And so he's finding himself in a little bit of a squeeze because as jobless claims rise, that is a sign of sort of cracks in the armor in the economy. And normally in response to that, they only have their two levers, right? Raise rates, lower rates, or, buy bonds, sell bonds, right?
Right. Yep.
So normally as jobless claims go up, he would then lower rates, right? To try to counteract that and stimulate the economy.
That is correct. Yep.
Now, in this environment, jobless claims are going up. And usually as jobless claims go up and the economy would be breaking, inflation would naturally be coming down in an economy that's in balance. Is that fair to say?
That is fair to say, yes.
But in this environment, our president has basically forced more inflation. He's fiddling with the economy in an unnatural way. So we're seeing jobless claims rise, but the inflation isn't really coming down. It's staying level or increasing a bit, which means either lever Powell pulls, he's going to screw something up.
Right. And through these inflationary actions, until we've seen like Powell even came out and basically said, hey, if we don't address this right away, we're going to see skyrocketed unemployment. We're going to see empty shelves. We're going to run into pandemic level supply chain issues where,
due to the tariffs,
because of the tariffs. Correct. If we're adding tariffs to goods that we're purchasing from other countries, a lot of those goods have already been produced. And so if we freeze or slow buy those, they're going to be a buildup. Then we remove the tariffs, and now they can't get into port, right? Like we're just creating this backlog of inventory. And again, supply, shipping and supply issues that are not advantageous for the economy.
Right. And yeah, you might be a company that's saying, well, he puts them on, he puts them off, he puts them on, he puts them off. I'm not going to import. They're on right now. I'm not going to import. I'm going to leave that stuff offshore. I'm going to leave that stuff in another country and wait 30 days because he's going to turn them off again. And when he turns them
Yeah.
off, I'll call all the boats in. And to your point, then the
Yeah.
port authorities completely overrun, and we've got pandemic insanity going on where we can't get the goods to market at that point.
Right. And as we do that, our current supply reduces. And when we reduce supply and maintain demand or even slightly decline to demand, the supply is reducing faster. So that means those prices of those goods are going up,
Yeah.
because there's more demand than there is supply, which adds to inflation. So it just doesn't appear to be a good cycle that we're in.
And one of the other things he was alluding to was that the on again, off again nature of this is making it essentially impossible to make predictions or to implement any fiscal response to this.
That is accurate. Yes, there takes, these numbers, oftentimes their numbers that they're reading are, months and months behind, month over month, and those numbers still get adjusted. But we're talking about, almost weekly on again, off again. There's not enough there to support the lagging data. And he needs
Right.
consistent lagging data. You just can't take a 2-week report and say, okay, this is the way it is. It's just not accurate. We got to go back and have sustained numbers over a quarter's worth of time or even longer.
Right. And agree with the tariffs or not agree with the tariffs. If Trump just left the tariffs on, we would at least see what they do and see the chaos and pain that they bring. And then Powell could try to craft a strategy to respond to that. Because maybe they're not quite as inflationary as he thought. Maybe there is an interest rate balance he could strike between job loss but he doesn't have the data because they're off right now, but they're going to come back on in 60 days. And who knows what those will be. It was going to be 104% on China. There was going to be 145% on China. Now it's like, well,
Yeah.
hey, we're friends. We're going to be nice to China. It'll be like, maybe 15, 20%. Who knows,
Yeah, and simultaneously that you got people that are, nearing retirement. You got folks that don't want to look at their 401k account because you're seeing the markets just really take a beating. And that starts to apply some pressure, for someone that, you might have really good intentions in what you're trying to accomplish, but what's the ancillary effect on the masses? And so it's you're starting to see a divide, not even a divide, a coming together, I would say, of different political parties that are saying, hey, this might not be working the way we intended to. My constituents in my region, my county, my state, they're feeling some pain right now, and so this isn't working for us.
Yeah, and we have not seen a White House response to those calls. We've seen little carve outs. Apple managed to get them to not tax their iPhones, but Tim Cook gave him $1 million for the inauguration. So we can't all do that. So we haven't seen big carve outs for individual state. There are states, Republican state governors petitioning all the time to try to get tariff carve outs for whatever their state does. Farming's
Right.
taking a big hit, especially like soybean farming and this kind of stuff. This generation of farmers is getting hammered by these tariffs at the moment. All of that kind of eventually washes downstream into the housing market, and the housing market tends to be a little a lagging indicator. The housing market is always in response to the macroeconomic trends in the country. It's not the first thing to crack, but once it cracks, it's often the biggest crack and the one that has the biggest impact on the economy. So obviously the big question on everybody's mind is how is this affecting interest rates? And then second off, how is this affecting housing? So I'll let you speak to what's going on with interest rates, Dave, and then I'll follow with some housing data so people can start to wrap their minds around how this is going to really affect them in whatever town they're living.
Yeah, and to the interest rate point of view, is we've seen not as drastic changes as we would have expect to see in the interest rate. So when you watch the stock market have these wild swings, higher or lower, typically we see these higher swings in our interest rates. But and I'm talking the 30-year mortgage-backed security, the 30-year mortgage, right now we're still hovering through all these wild swings. We've been between 6.5 and 7%.
Yeah.
And that's a pretty tight range for the wild movements we're seeing in the stock market. And so a couple things are happening is, oftentimes we would see flight to bonds when the stock market is tanking or is way down. We're not seeing that. We think that the consumer confidence and the confidence level is so low that there's a flight to cash. And so people are hesitant because we're seeing, day over day or week over week wild swings. Is what do we do with that money? And right now the safe haven's cash.
Yeah.
Until we really get an understanding, are these tariffs on again, off again? Where are these, money's going to be parked? Until they start moving to the bond market, we're not going to see an increase or an improvement in interest rates.
Yeah, yeah. If you're out there right now on YouTube and you're watching financial influencers, which by the way, most of whom have no idea what they're talking about, so be very careful with that. But you'll see that normally some of these guys are 10% in cash, 15% in cash. You're seeing people posting up minimums right now, 30% in cash, 40, 50% in cash. Some of them are doing that because they have the wealth to see this as a buying opportunity. Others are doing that to take risk off the table. But for in layman's terms, what Dave's talking about, flight to bonds, flight to cash, when equities fall like a stone, the stock market, right? When Coca-Cola, Apple, Nvidia, all these are dropping, people go and buy bonds, government bonds and things like that because they're safe. They're going to get a lower yield, but they're not going to lose their backside on them while the market's tanking. That is as predictable a human move as we have in the stock market over the life of the stock market. Trump has, with the on again, off again, and the chaos, has jangled people's nerves so much they don't even trust that move to bonds, and they skipped over bonds and just had a big, massive sell off and pulled their money out, and they're sitting it in cash. I'm having it in cash because maybe it's going to be an awesome buying opportunity. Maybe Trump's going to announce 400% tariffs on everybody next week because he has a 2 a.m. Manic fit, and then I can dump all my money back into the market and make a killing, right? Or maybe I'm Joe Main Street, and this is all the money I have in the world, and I getting close to retirement and I can't afford to lose it all, so I'm dumping it into cash. I'd rather be out of the market than at the whims of the market. Because what if he does have a 2 a.m. fit that causes the market to tank and I lose everything and I got to pull money out next week for my annual withdrawal for retirement? So people just moved a lot of money into cash, which doesn't have a positive effect on our interest rates. The flight to bonds changes the yield of the 10-year T-note, which has what effect on our interest rates, Dave?
The move to T note. So if you watch the T note, and the T note's actually relatively flat, the 10-year treasury, we've been seeing it hover right around 4.3. As someone that's out there, if you're looking at the 10-year treasury, usually as a rule, you had about 2.5 to that 10-year treasury, and that's going to be the mortgage rate.
Yeah.
So, you're looking at, if we're right now, I think we're hovering today, I want to say 4.35, add 2.5 to that, 4.8, you're looking at 4.8, or excuse me, 6.8 interest rate in that range, 6.8 to 7%. And that's really holds true if you look at the history of the 10-year T note, and you can kind of watch what interest rates did, and they kind of mirror each other.
Yeah, and of course, the fine print here, folks, is we're not quoting you interest rates you can get. That's dependent on your own credit scores and income situation, all that. We're just talking generalities here in the market. But had a bunch of people flown into the bond market for safety, the yield on the T note would have gone where, Dave?
If they had gone into the bond market, then the bond interest rates would have gone up, which would have caused mortgage interest rates to come down. So
Right.
yes. So higher
Yeah.
bond market, lower mortgage interest rates, and that's what we want to see.
Yeah, that's what we expected to see. That would have been the only bright spot in what otherwise has been some pretty grim financial news. And that didn't even happen because he scared people so bad they skipped over that move and went right to cash.
Yes, and I talk to a lot of people, and some people are, understand that the idea or the principle behind some of the tariffs. Some folks might come out, and I've heard people say, "Okay, I understand what we're trying to do is get some type of trade balance." It's the way we're going about it is really causing the chaos in the market. So, I'm no economist, not a politician, obviously either. But just the way we're going about this just is not working, and consumer confidence is spiraling.
Right. And we are essentially a confidence-based market. As you hear us saying, people get scared, they do this with their money. We have this false assumption that we are all rational, logical actors, and we're not. We're just a bunch of scared monkeys running around in the forest. And when somebody does something scary, we run. Right. And so financially, when someone does something scary, that run is to cash. It's not to go hide behind a rock because there's a bigger predator. It's to go to cash. And that's what we're seeing. So in a confidence-based market, when people lose confidence, everything goes bad. And consumer confidence, by the numbers, is the lowest I've seen it in my entire career at this point. So what does this mean for housing? What does it mean for your home prices? Where are home prices going to go? Where are interest rates going to go? At this point, this is always crystal ball work. And in this kind of market, it's extreme crystal ball work. Anything we say could be out the window tomorrow by some new, fiscal policy. Their fiscal policy is flying off the Resolute desk quicker than you can say Sharpie these days. So we could end this pod and pull up the news and find out everything we said is out the window. But in general, Dave and I, correct me if I'm wrong, believe that in the near term, if the chaos continues, the people aren't going to move into the bond market, and we aren't going to see appreciable swings in the mortgage interest rate. Would that be fair to say, Dave?
That is fair to say. That is what we are seeing right now, and we can't expect, without adding to the debt, the Fed to come out and promote a bond buying program that will stimulate those bonds to help lower mortgage interest rates. So we're kind of stuck in a corner here. We're market dependent.
Yeah. And the Fed right now, with the chaos, is essentially having to do what every American's doing, which is pull everything close to the chest and wait and see. And so we
Yes.
can't count on the Fed to lower the Fed funds rate to have any effect on mortgage interest rates either. So as of now, until there's another swing here, Dave and I predict essentially continuing to bounce around that 6.5 to 7% range, for the foreseeable future. Yeah.
Yes, and I would say the only thing that is certain right now is uncertainty, right? Like, um,
Yeah.
and we're we've been doing this a long time, Rich, and we're used to peaks and valleys, and we could usually see what's coming down the pike, and the numbers will show which way we're trending. And does it always make sense? No, but we can at least have a general idea. I think we're in a situation right now where something, and we always say that something's got to give. At some point, something's got to give, and what's that going to be? Is that going to be? And I don't see mortgage rates coming down quickly, and I don't see the level of the inventory increasing enough to put pricing pressure on sellers. Maybe we've seen a little
Correct.
bit of that, but I'll let you speak to that.
Yeah, yeah. And the hard thing now is if you throw the tea leaves on the table and you start to look at them, you think, oh, never mind, I'm going to pick them up and throw them again and see if I see something. The numbers are muddy and unclear. So I'm going to go through the real estate numbers with y'all, and I'm going to point to some things I think are leading indicators of what we're about to see. So I'm going to share some data with you here. We'll pop this up on your screen. And what you're seeing here is a graph of the for sales, sold, and pendings from January of 24 to essentially today, March of 25. We're recording this in April, but we don't have April numbers yet. And I'm going to clean this up a little bit and just go for sale and pending, take the solds off there. Because what I actually really care about right now is the number of pending sales. So if we look at March 1 year ago, we've got this pending sales number around 373. This is for El Dorado County, by the way. So we're talking local real estate, El Dorado County. And if we look at pending sales for today, we're looking about 200. So, you can see, pardon me, where we go back to 324. Sorry, we're looking about 175-ish, 173, and we're looking at 200. So we've seen an increase in pending sales year over year. In fact, as you can see, if you can see the pop-up on the screen, for homes placed under contract, we're looking at a just shy of 20% increase year over year. This is local numbers for El Dorado County. This is in a little bit of contrast to the national numbers. Nationally, we're seeing about a 5% reduction. Statewide, we're seeing about a 5 to 7% reduction year over year in pending home sales. So nationally, pending home sales are starting to slow. Statewide, pending home sales are starting to slow. El Dorado County, we're still up. And again, these macroeconomic trends really they do trickle down. They go from the national level to the state level, and in the state level, you're going to see it hit the major metros before it's going to hit the rural areas in this direction. The rural areas, we always get hit harder, but we get hit a little later. So we are seeing still pretty solid numbers on number of pending home sales. So if I was only looking at local news, if I was only looking at local numbers, I'd say we're doing all right, you know. But I can already see that sort of offshore wave coming from the national and the state numbers. If we look at average price, the green line here is for sale. That's what people are asking for homes. I don't usually put too much stock in that. These are the wishes and dreams. Sorry to say, the sold numbers, the red, what people actually sell their homes for. That's the important number. If we go back to March of 24, again, we're looking about an average of $750,000 in there. And if we come to today, we're looking at an average just above 800, around 810, 815 or so. So here again, in terms of the sold price, we're up. We're up 8.4%. You can see on the little pop up here, year over year for all of El Dorado County. These numbers are a little bit skewed because of the bookends of El Dorado County. Remember, we have a lot of rural in the middle, and we have El Dorado Hills with, median home prices in the $1 million range, and South Lake Tahoe with median home prices close to $1 million at the other end. So the bookends of El Dorado County post up some big numbers, and everybody in the middle doesn't. So these numbers do get a little skewed, but either way you slice it, in terms of sales price, we are still up year over year. Now, where we're starting to see the cracks is a little bit in days on market and a little bit more in inventory. So when we look at days on market, if you just look at this sort of macro trend here, it looks relatively flatline, but when you dig a little deeper, we are seeing a 2% increase compared to last year in the number of days it takes to sell a home. Is that a big deal? If it took you a few days longer to sell your home? No, nobody cares. But it is an indication that we are moving towards a softening market, because days on market have been wildly low ever since COVID around here. So we are seeing some softening there. And then months of inventory, we're seeing a bigger impact here. So months of inventory mean that at the rate that homes are being sold, if no more homes came on the market, based on the number of homes I have today and the rate at which they're selling, I would have no more homes to sell by this amount of time. So in March of 24, that was here around 2.7 months of inventory. That means I would be out of homes to sell in 2.7 months if no more homes had come on the market. Thankfully, that didn't happen. Here we are today, and we're around 3.4 today. So not quite a full month of additional inventory, but close to a month of additional inventory. And why this matters is because under 3 months of inventory is a strong seller's market. 3 to 6 months of inventory is a neutral market by the data, although locally I consider 4 to 6 months of inventory a little more of a neutral market. And then, 7 months and up is a really strong buyer's market. To put that in perspective, at the height of the Great Recession, we had over 18 months of inventory in the greater Sacramento area and El Dorado County as well. So that was a wild buyer's market. And for most of COVID, we had less than 2 months of inventory, and it hasn't really gotten much higher. That a year ago, that 2.7 months of inventory represents actually an increase in inventory from the few years prior. So to be getting to the 3.4 months of inventory, approaching what sort of statisticians would say is a neutral market, but what I would say is just shy of a neutral market, that is a compelling data point. That is a market shift in the offing, in my opinion, where we are now getting to the point where we might be approaching a neutral market. And once we hit that neutral market, if inventory continues to climb, then we would start to see more price reductions and start to see more inventory pile up and start to move towards more of that buyer's market environment down the road. And those are all signs that we are entering into recession, in my opinion. So there's a lot of debate out there right now. People say, are we in a recession now? Are we heading towards a recession? We probably have a hot take on that on this podcast. But Dave, where do you stand on your reading the tea leaves in regards to recession right now?
Well, in my opinion, we've entered recessionary territory, and the market doesn't always indicate that, and even some companies that aren't necessarily laying off employees. They're not hiring. We're seeing, companies contract and gets a slightly smaller workforce. And it's just folks that I talk to, based on what I'm seeing, I just go back to kind of how it felt before the mortgage meltdown there and the Great Recession. It's eerily similar to that feeling of what's going on. But that doesn't mean we couldn't really recover quickly. But I just get that's the sense. And again, it comes back to what we talked about earlier, that consumer confidence. And so as you were talking about the numbers and the inventory, question for you, and we didn't talk about this earlier, but as you're seeing listings and we expect really the selling season to really start to increase, right, over the next month or two, the number of folks that, want to list their homes, and it's that time of year that it really is considered selling season. Are those folks saying that, hey, we got this low mortgage rate, but we're going to sell anyway? When you're talking to these potential sellers, are they alluding to that, or is there?
In my opinion, the market, from a seller's perspective, is still mostly have-to sales. Like once the interest rates increased in like July of 2022, my sales board was all death and divorce for a while there. It was only have-tos. And now we've seen some what I'd call like a voluntary have to, like a lot of the grandparents selling off to move to another state because their children just had grandchildren, want to live near the grandchildren. We're seeing some of those people come back to the market. So there is a loosening in that sense. It's not just, I absolutely have to sell. We're seeing there's a compelling reason in my life to sell, and I'm willing to eat the mortgage rate to get that to happen. And again, that comes down to that confidence piece where people are getting the message that 3% is not coming back. And so do they want to keep their life on hold because of an interest rate? And I'm seeing that category of people is starting to break free. And I think that is why we're seeing more inventory right now. Is more the people sort of getting the sense that the low interest rates aren't coming back. I'm going to just move on with my life. I don't think, in my opinion, yet we are seeing the inventory rise due to the joblessness, the job loss numbers. The job loss numbers, we're seeing increases. Those are national numbers. So in any one of our small communities, that's not a significant number yet. I mean, if you're living in a town where, Stellantis just laid off 900 people from the auto plant, maybe in that town, your inventory numbers are starting to reflect job loss. But, here in Dorado County, our inventory numbers are not yet reflecting job loss. But the combo of those two things, the people just moving on with their lives, and then the job loss listings, we could see that inventory number start to pick up because of that down the road.
I think from my end on the interest rate, when I talk to potential home buyers, I think there's more of a commonality that rates are what they are now, and this is the foreseeable future. There's not those folks that are necessarily, not as many that are holding on to a sub 5 rate holding out for a sub 5 rate, or even a sub 6 rate at this point. I think right now, anywhere in the 6s and even low 6s would be considered a favorable rate at this point in time. And I think that's good in terms of you're not getting your parents' interest rate anymore.
And I think we're going to see consumer confidence is going to have a way bigger effect on the market than interest rate now moving forward. Redfin just posted a study that they say 1 in 4 home buyers and home sellers are pumping the brakes right now due to economic uncertainty. Now, the numbers I just presented to you don't reflect that yet, so they're doing a poll, but again, we're not going to see those numbers kind of wash out into the mix for another few months. We also are facing down, I think we're 15, 20 days into the 90-day tariff pause, and we're entering into the buying season right now for most people in summer. So, if you fast forward 75 days, that puts us May, June, mid-July. So at the height of buying season, he might crank those tariffs back on, and then we're going to see, as the late summer numbers come out in fall, we're going to really start to see the impacts of what this year shaped up to be in real estate. And I think what we're going to see is lower sales volume, softening prices, all this sort of thing. We already see a lot of real estate research folks adjusting their opinions now and saying that we're going to see a 1.7% decrease in home value this year nationwide versus an increase. So they are starting to predict the same thing I'm saying, which is by the end of the year, we're going to see that to your point, we already are in the recession, and the numbers will have washed out to where we can see that it actually has the effect on housing that we expect. And of course, like Dave and I said, this can change at any moment with the chaos coming out of Washington. So, and that's why we're coming to you every week, giving you the update where we stand, what the numbers look like. So if you are one of these people that are got to make a decision soon, then really, tune into this space and subscribe. We'll give you updates every week so you can start to frame your decision making around these things. And if you're stable where you're at, then maybe turn off the news for a while and don't ride the roller coaster with us, because it's wild out there.
Yep, I agree.
All right, guys, I think that's a good place to wrap it today. From the 30,000-foot view, we don't see interest rates going anywhere for a while. We see signs of cracking and softening in the housing market. We believe recession is real close, knocking at the door, or we're already there and we just don't know it in the numbers yet. And so we will keep you posted as things unfold. I'm sure something chaotic will happen in the next few days, and we'll come back to you and talk about it next week. As always, thanks for watching. I'm Rich Curtis.
I'm Dave Miller. Thanks, Rich.
All right, we'll see you guys next time.